welcome. This is the beginning video to a basic options trading course. Welcome to the world of option trading. If you are totally new to options, then this course is for you. In this course, I fully and completely break down option trading, and I explain each part in a way that is simple and easy to understand, including showing lots of examples. Options are one of the most, if not the most, diversified trading instruments available. In addition, one can trade some option strategies with very little money, much less than it would take to trade stocks. One of the benefits of options is that one can increase leverage while at the same time reducing risk or capping risk to a fixed maximum amount. So what is an option? An option is a contract that one buys that locks in a buy price or a sell price on a particular stock for a set amount of time. There are two types. One type, which is called a call option, gives the contract holder the right to buy a stock for a predetermined set price within a set time period. The other type, which is called a put option, gives the contract holder the right to sell a stock for a predetermined set price within a set time period. An option is a contract between two people, a buyer and a seller. A seller is also called a writer because the seller is technically writing a contract and selling it to the buyer. When someone buys a call option, they are buying a contract from the contract writer, also called the seller. The contract states that the option buyer is entitled to buy 100 shares of a particular stock for a preset price. The contract also states that the option seller agrees to sell the option buyer that stock at that preset price, if and when the option buyer decides to buy it, up until the time the contract expires. The buyer of the option contract has the choice of whether or not he wants to buy the stock from the option writer. His contract says he has the right to do so, but it is his option, which is why they're called options. In other words, when someone buys a call option, they're locking in a preset buy price for a stock. When buying an option, there are many choices for the preset buy price. For instance, if the stock is $10 a share, one can buy a contract locking in a buy price of $10, or they could buy a contract that locks in some other price, $9, $8, $11, $12. Of course, the different contracts cost different amounts. When someone buys an option, there is a time limit on how long the buyer has to exercise or use the option. The longer the time limit, the more the contract costs to buy. Just like a call option, when someone buys a put option, they are also buying a contract from the contract writer, also called the seller. The contract states that the option buyer is entitled to sell 100 shares of a particular stock for a preset price. The contract also states that the option seller agrees to buy that stock from the option buyer at the preset price, if and when the option buyer decides to sell it, up until the time the contract expires. The buyer of the option has the choice of whether or not he wants to sell the stock to the option writer. As an option trader, one can choose to be a contract buyer, in other words, they can buy an option, or they can be a contract writer, in other words, they can sell an option. Both have advantages and both have disadvantages. So why would someone buy or sell an option? What is their purpose and what are they used for? Options have many uses, and they are actually one of the most diversified trading instruments out there. However, there are three main uses. The first is that one can use an option as an insurance policy to limit losses on a trade to a preset amount. For instance, if a stock is $10 a share, a trader can lock in a sell price for a fee and not have to worry if the price of the stock drops in price. No matter how low the stock goes in price, the option holder has locked in the right to sell his stock for a preset price. One can also use an option for speculation. For instance, let's say hypothetically a stock is $10 a share, and a trader feels the stock is going to increase in price. For a fee, he can lock in a predetermined price to buy the stock in the future, no matter what the price of the stock is at that time. If the stock is $10 a share now, for maybe $1 a share, he can lock in the right to buy that stock for $10 anytime during the next month. Then, if the stock increases in price to $12, $15, $100, any price, the trader can then use this option to buy the stock for $10 and then immediately sell the stock for the higher current price, making the difference in profit. The third main use for options is a hedge to mitigate risk. A diversified portfolio that includes options can be set up in a way that greatly limits losses for extreme market moves. In addition, companies sometimes use options to lock in future prices, similar to the way they use future contracts. There are many different strategies for trading options. Some strategies are very risky and come with large gains or losses. Other strategies are very low risk and come with capped gains and losses to a fixed maximum amount. Some strategies involve combining two or more options in different ways to profit in ways other than the change in stock price. For instance, options could be combined in a way to profit when the individual stock or even the overall market gets more volatile or less volatile, or to profit when other things happen such as changes in interest rates. For this course, for simplification, I'm going to focus on stock options only. However, there are options in other markets that work basically the same way. Options can be a bit confusing at first, but after one learns the basics, they realize that options are not complicated. In the next several videos, I will break down options in detail in a way that is easy to understand.